Welcome back, Deep Divers. Great to have you with us again. Today we're tackling the final and honestly super critical part of the COSO ERM integrated framework. It's all about information, communication, and reporting. Basically, how do you get the right info to the right people, at the right time? It's key for managing risk well. Now, before we really get into the weeds, just a quick reminder, this deep dive pulls from material provided by Farhat Lectures. All the content, the examples, the explanations, it's all derived from the great accounting resources over at farhatlectures.com. So, if you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely check out the website. They've got loads of practice questions, video lectures, and really good support to help reinforce what we talk about today. A big thank you to Professor Farhat for sharing this material with us. Okay, so as we know with ERM, it's tempting to just, memorize the lists, the mnemonics, but that's not really what we're about here. We want to understand how these pieces fit together, why they actually matter in the real world, turning data into actual wisdom, right?
So let's kick things off with the first principle here, leveraging information systems. Okay, we hear information systems, maybe think IT departments, databases, but what does leveraging really mean in a risk context? Why is it so important?
Right. Leveraging information systems. It's definitely more than just having the systems in place. It's about actively using the tools and data you have to your advantage, specifically to support ERM. Think about how organizations, well, they capture so much data, right? Internal stuff, external stuff, maybe even data they buy or download. The whole point is to process that raw data and turn it into useful information that actually helps make better decisions within the whole ERM setup. Like, take airline companies. They're constantly scraping competitor pricing data from websites, open sources. Why? To set their own prices competitively, it directly impacts their profitability, a major business objective.
Okay, yeah, I see that.
Or hotels, they do the same thing, pulling data from sites like hotels.com or Travelocity. It's about using available information strategically.
That makes sense.
Yeah.
And you mentioned different kinds of data, internal, external. What about the structure of that data? I know that comes up a lot.
Absolutely. That distinction is pretty key. You've basically got two main types. First, there's structured data. This is the neat stuff. Well organized, fits nicely into rows and columns, like in Excel or a database. Think numeric figures, things you can easily search, analyze, run averages on, regressions.
Got it. The orderly data.
Exactly. Public indexes, database files.
Yep.
It's designed for analysis. Then you have unstructured data. And this is, well, it's messier. It doesn't have that predefined pattern. Think emails, Word docs, photos, websites, text files, social media comments.
So much harder to just pull insights from automatically.
Way harder. But, and this is important, both types are valuable. It's just that structured data is generally easier to analyze with traditional tools. Unstructured often needs more advanced techniques like AI to really unlock its value for risk insights.
Right, especially for those early, maybe subtle warning signs hidden in text or images. Okay, so once we've gathered and maybe analyzed this data, the next step is crucial. Communication. It sounds simple, find a risk, tell someone. But why is getting this communication piece right so fundamental for ERM?
Well, it's absolutely vital because after you've gone through the process, identified risks, assessed them, prioritized them, none of that matters if the right people don't know about it in a way they understand. Communication is what connects the analysis to action across the organization. And it has to be relevant. Each person needs to grasp the risks that pertain specifically to their job, their department. Like the example you mentioned earlier, someone working in a warehouse needs to be crystal clear on safety risks, maybe inventory spoilage risks. They probably don't need detailed briefings on foreign currency fluctuations.
Whereas the accounts receivable team definitely does.
Precisely. That currency risk is central to their world. So tailoring the message is key. And it's not just internal. You need open communication channels, potentially with external parties too. Think regulators, the FDA, IRS, SEC, FAA, Department of Labor, depending on your industry. They often require specific risk information.
Compliance reporting.
Exactly.
Yeah.
And internally, that constant dialogue between management and the board of directors about risk appetite, about what's changing, that's critical. Poor communication leads to blind spots.
Okay, so the tailoring and the open channels are key. What about the how? What methods are organizations actually using to get this risk information out there effectively?
Oh, it's a whole mix of things. There's no single silver bullet. You've got The standard methods, of course, meetings, emails, written reports, maybe posters on public boards in some workplaces, but also town hall meetings for broader messages, crucial one-on-one discussions for sensitive or specific issues, and things like whistleblower hotlines. They're a really important communication channel for uncovering risks that might otherwise stay hidden.
A diverse toolkit then.
Definitely. The goal really is just to make sure everyone who has responsibility for hitting business objectives or executing strategy is aware of the risks involved. That's how you maintain control.
Okay, understanding breeds control. That leads us neatly into the final piece of this component, reporting. So we're communicating the risks, but what exactly should the reports cover? Is it just a list of potential problems? What makes a report genuinely useful for decision-making?
Yeah, that's a great question because effective reporting is much broader than just listing risks. It really needs to include insights on the company culture, how does the organization approach risk, and also performance across different parts of the business.
So context is key.
Absolutely. The why is to help people make better decisions. They need to see the connections, the relationship between risk, the prevailing culture, and how the organization is actually performing. This is especially true for the folks setting strategy, overseeing governance, and managing daily operations. They need that integrated picture. And for the reports themselves to work, they need certain qualities. They absolutely have to be accurate, obviously. Complete, no leaving out the awkward bits. They need to be clear, easy to grasp, and critically, they should be forward-looking.
Not just looking back, but looking ahead.
Exactly. A good report helps decision makers anticipate what might happen and make better choices now to prepare or prevent issues. It should guide future actions.
That forward-looking aspect seems vital. But reporting takes time and effort. How often should organizations be doing this? It can't be the same schedule for every risk, right?
No, definitely not. The frequency really hinges on the severity and priority of the risk. It's very context dependent. Take a crisis situation, maybe like the early days of the COVID-19 impact on supply chains or something. You might need daily, even hourly reports in some functions because things are changing so fast.
High severity, high frequency.
Right. But then think about something less severe, maybe an ongoing operational issue, like, say, minor safety incidents in a large retail chain like Walmart. That might be tracked and reported weekly. Enough to see trends, but not a constant emergency. It depends on the risk's velocity and potential impact.
Okay, that makes sense. Tailored frequency based on severity and speed. Now, one last distinction that often comes up here. KRIs versus KPIs. Key risk indicators and key performance indicators. They sound similar, but I know they do different jobs. Can you break that down for us?
Yes, and it's a really important distinction to get right. Let's start with key risk indicators, or KRIs. Think of KRIs as being predictive. They're like your early warning system. They give you a heads up about potential future problems or unfavorable events. They monitor changes in your risk exposure, looking for signals that things might be heading in the wrong direction. The whole idea is to spot trouble early enough to maybe prevent a crisis or lessen its impact.
Like a smoke detector for business risks.
Kind of, yeah. A good example might be seeing an upward trend in the default rate among your customers, but specifically within one industry sector, say construction, while others are fine. That specific trend could be a KRI signaling future problems in that part of your loan portfolio, even if the overall default rate, a KPI, still looks okay. It's about spotting the leading edge of a problem.
Okay, so KRIs are forward-looking warnings. What about KPIs then?
Right, so key performance indicators, or KPIs, are different. They mainly give you a high-level view of past performance. They tell you how the organization has done. Think of them as looking in the rearview mirror.
Historical data.
Exactly. They don't typically provide those early warning signals for future risks. They're usually after the fact. So a KPI might be 5% of our total loan portfolio is currently in default. Or it could be sales growth last quarter or customer satisfaction scores last month.
Useful for tracking progress and seeing what happened.
Very useful for analyzing trends, measuring success against targets, understanding historical performance. But they tell you what has happened, not necessarily what's about to happen. KRIs are for foresight, KPIs are for hindsight, and current state measurement. Both are valuable, just for different things.
That clarifies it perfectly. KRIs are the look ahead, the early warning. KPIs are the look back, the performance review. Wow, okay. So that wraps up our deep dive into information, communication, and reporting, and really our exploration of all 5 COSO ERM components. We've seen how crucial it is to leverage information systems, communicate effectively, report clearly. It all ties together for organizational resilience. And just to echo what we said earlier, truly understanding this interplay is so much more powerful than just memorizing the terms.
Couldn't agree more. And the best way to really cement that understanding is practice. Working through multiple choice questions, applying these ideas to case studies, or even just thinking about them in the context of businesses you know, that really helps. And again, resources like those at farhatlectures.com are fantastic for that kind of reinforcement learning. They offer the practice and detailed explanations that can really make these concepts stick. Definitely worth checking out if you want to go deeper.
Absolutely. So as we wrap up, here's something to chew on. Think about your own world, maybe your job, your team, even a personal project. Considering everything we've discussed about information, communication, and reporting, what's one piece of, let's say, unstructured data, an observation, a recurring comment, a subtle pattern that you might be overlooking right now? What risk or maybe even hidden opportunity might it reveal if you could just capture and analyze it effectively? Give that some thought. Thanks for joining us, and we'll catch you on the next Deep Dive.